Well, stocks continue to surge as the latest economic data points to cooling inflation and a slowdown in consumer spending. Investors are now betting that the Fed's job is done for now, spurring this market rally. So where are the best buying opportunities at this time? For the answer, let's bring in Ken Mahoney, CEO of Mahoney Asset Management. Ken, I hope you have some answers here, but let's start with that data that we got today. As Jared noted, we saw the first monthly decline in that headline number in a while, but we're still talking about a resilient consumer. How long does this last?
I think it has more legs. Like we came into January this year and everybody said, we're going to have a hard landing. The only question is the cockpit going to fall off, or is the fin or the tail going to fall off? I mean, I was so convinced. And now, in the last couple of days between the Department of Labor's, report on Friday, the CPI yesterday, the retail sales started to add up that, wait, maybe we were wrong about this hard landing. Maybe this is Goldilocks after all. Goldilocks, hey, not too hot of an economy to have the Fed raise rates. They're in a pause, and market's not in a pause whatsoever. They're off to the races, and yet not too cold for companies not to have decent earnings. So this is now being recognized as a sweet spot between now and the end of the year. We don't see any Fed increase or Fed fund rates increase, and they're out of our hair. And we may have some performance anxiety. Those who are bearish, from pretty much this entire year, probably have to hold their nose and pick stocks, but they have to keep up with the Joneses if they're going to want to get their bonuses.
So then, Ken, talk about some of the sectors where you see the opportunities. A lot of people still had money on the sidelines wondering, should they be chasing bond yields? Where do you think is the best place to put money to work right now?
Look, I still like big tech. And look, no doubt we've had a tale of two stock markets. One is technology and everything else. And now we're starting to see the everything else, including small cap, as you profiled earlier. The small cap index was up 5% yesterday. That's ginormous. But we still see liquidity in these big names, Apple, Microsoft. These are companies that beat estimates, for the quarter, September 30th. These are the same ones actually guiding higher. Look, they need to take a breather, no doubt. I mean, some things are nosebleeds here. We get it. But remember, we were deeply oversold August, September, and October. And now we get some breathing room in November. So it may have more legs, but I'm still sticking in to the fabulous seven, so to speak, and be willing to buying any pullback.
And when you think about the market reaction to yesterday's inflation print, looking at where stocks have continued to extend their gains today, how much of this is just sort of that knee-jerk reaction? How much of this you think are levels that can be sustained, to your point, with the expectation that it's not just a pause anymore, this tightening cycle may have peaked?
Right. So I think this has legs. Now, look, will I be adding money today? I don't know. This is kind of overbought very quickly. The market goes very quickly. Oversold. No one wants stocks, overbought. But remember, we were looking for a catalyst to get some of these $1 trillion out of the money markets and into the market. And I think, this FOMO's come back to town, FOMO, fear of missing out, at least fear of missing out this rally in November. And, that can have a lot longer legs. Just like, when sticking to the downside, like, oh my gosh, when is this negativity, this Chinese torture going to end, the August, September, October days. And just on the other side, it can stay sticky for some time because FOMO is very real and momentum can carry for quite longer than people expect it can.
So Ken, as Jared was mentioning earlier, obviously we're seeing the markets looking ahead, pricing in for a soft landing here. The Fed is saying, no, that's not the case. Markets not believing them at the moment. What are some of the risks that people should be aware of as they're trying to not fight the Fed, but markets have obviously jumped ahead at this point?
Yeah, look, the expectation is the Fed is done. They may not be done, right? We may get a hot PPI number, CPI number somewhere along the way, and that would quickly have yields go higher. This whole year has been seesaw. Higher interest rates, lower stock prices, lower yields like we saw the last few days, higher stock prices. So, I can't say we're out of the woods together. It's still very data dependent. But I will say this, though. A lot of people are talking about these rate cuts happening next year. I don't see that. Again, I know Fed fund futures are showing by May, maybe a rate cut or two. I do believe it's going to be higher for longer. They may not raise rates, but I think they're going to keep it longer. And be careful what you ask for. If you ask for rate cuts, what's accompanied with rate cuts? Probably like a negative GDP print. So be careful what you wish for.
So Ken, if you expect those rates to remain where they are right now, do you stay away from growth names? Because that's where they've really suffered, right? I mean, the expectation here that the higher rates have hurt so many of these companies that have taken on a lot of debt.
Right, they have it. But again, a lot of these growth companies, though, I think are set up pretty well. A lot of the growth companies do wrap around technologies like AI, software learning. We're in that hockey stick of growth right now. Higher rates definitely dampens the spirit of growth names and so forth. But if the argument is we're going to go to some type of recession next year, I would actually argue that a lot of these same technology companies are somewhat shielded from that. I mean, we're still going to use our Apple phones. We're still going to, do Google searches. We're still going to buy on Amazon. We're still going to use our Microsoft Team meetings. And, so again, I think there's, again, it can go both ways, obviously, but we think it's going to go positive because really, I think investors at this point in this market cycle want to see consistent earnings, and these big companies do deliver those consistent earnings.
Certainly seems to be the case so far. Ken Mahoney, CEO of Mahoney Asset Management, thank you for joining us this morning.